Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds.
By the way, what do you think? The market has had some weird gyrations the last week and a half. First with rotation and some decent volume. IWM broke out, but at the same time, you get finally what some are calling the beginning of the tech wreck, others calling just an overbought consolidation. You know, after running and running, basically the only thing that's been bullish has been tech this year. We have a lot of data to get to. We're going to go through a relative strength rank and trend reports, and AA, of course, our certified market technician in training, who will be analyzing the charts for us. And I've got the relative strength rank and trend report, so we can kind of compare index ETFs. Have you noticed, AA, that the and of course we're now recording this minutes after it became official that the president is going to leave the race. So that kind of puts politics into turmoil. The question is, do markets like that, or do they hate uncertainty? And my feeling is that most of the pundits and big money center trading folks think that anything that points to Trump getting into the White House, they think is good for business. And so the market tends to rally off that. That's at least the consensus viewpoint that I've been exposed to.
Yeah, I mean, makes sense. And, you know, as far as the pullback goes, maybe it's just that. Maybe it's just a healthy pullback. I mean, there's no reason to have a market in turmoil special quite yet.
Yep.
Sure.
So, and I think that is going to be my takeaway in this version of cheatsheets.com. Stockcheatsheets.com is a Substack publication that I publish a few times a week. A lot of information is free, which we're going to go over today. And we can think of this video as not just a review of markets, but also sort of a visual aid to understanding the data that we share with you. It's really pretty powerful data. And basically, I'm just aggregating and consolidating it and then assigning a value to it. And you can decide what to do in your own personal research. Never construe any of what we're about to share with you as an investment, as advice to buy or sell shares. Everybody's financial circumstances are different. So with that disclaimer out of the way, the rank and trend report is basically kind of three sections. The relative strength rank and trend is we're using a relative strength measurement that compares price action in different look-back periods from 160 days to 10 days. So you read this from left to right. And as you know, AA, red to green is bullish and green to red is bearish in general.
Okay.
And what we're looking for is in these various look-back periods, how prices are performing relative to the market and hence then relative to each other. And this is nothing more. These numbers represent ranks in each of these snapshots. So when you see a number gets smaller, it means their rank is getting higher because 20th place versus first place, right?
Okay.
And we like rank transitions in the sweet spot because of the time frame that's important to us. 120 to 60 days represents approximately the last 3 to 6 months, which, you know, we never, as trend followers, we never capture the beginning of trends and we never get out right at the top. So the sweet spot is sort of that middle. Mm-hmm. But what we look for are signs in the more recent period, 50 to 10 days, where we look for weakness, meaning we start to see a transition from green to red. And when we see that red, those red splotches get into the sweet spot, then the chances of a sustainable bearish, or again, if it's going the opposite way, bullish trend begin to, the odds of success begin to get greater. And then everyone's got their own opinion about when to enter. Do you do it early? Do you wait for confirmation? At Cheat Sheets, we've decided that Chaikin money flow is a wonderful confirming indicator because it is the thing that measures institutional buying conviction, and it's based on price movement and volume. Stocks that close near their high toward the end of the trading day have bigger money flow, and those that on heavier volume, and the lighter volume closes is not as important, but heavy volume and stocks closing near their lows for the day, it's going to be a significantly negative money flow score. And then you average it out over a 21-day period, and then you trend it over time. So money flow is a snapshot, and then relative strength is kind of sort of a trend. And then in the middle, maybe you could take this. We've got our three actual trends.
Yeah, and remind me, I can't quite see it on my screen.
Left side is the 5/20
Okay.
moving average, and then we've got the daily 1040 pair, and then the weekly 1040 moving averages.
Got it. And
Shortest to longest term, left to right.
right. So it's basically just a way to confirm trend by whether price is above those EMAs and which direction those moving averages are pointing.
Yep, exactly right. And for the purposes of this, we need these moving average, the longer term moving average pair to be moving in the direction of bullishness or bearishness. But we don't need price necessarily to have crossed above that yet.
Yeah.
But generally, it is up above it. But essentially, trend would be the lagging indicator. Money flow and relative strength, leading indicators. In general, money flow happens first. And any score below 0.1 is considered pretty neutral. And if you're below negative 0.1, it's pretty bearish. So the real bullish confirmation comes with what I like to call a FOMO level of money flow, 0.20 or higher. And just weeks ago, most international ETFs, which is what we're looking at here right now, this would be the global market ETF comparison. Most of these are, we're extremely bullish, but I don't see that now. There's very little in the way of extreme bullishness on this chart.
Yeah, just a couple with money flow greater than what you just described as FOMO, 0.2 or better, 0.20 or better.
Yep. And so to be graded, you need to have sustained money flow rank in, sustained relative strength rank in different time frames. So for example, EWI holds on to a B rating. That B rating is because when you average the 120-day ranks and the 60-day ranks, you can see Italy is getting weaker and losing relative strength, but it hasn't crossed that threshold where it's in the bottom 50%, at least on an average basis. But that doesn't give Italy a hall pass. It is, in fact, in the sweet spot weakening. That is a disqualifying metric right there when you see it going from, and I'm talking about EWI here, when it goes from fourth at the 110-day look-back period to 18th at the 60-day look-back period. Right then and there, that is a significant bearish relative strength rotation. Now, the trends are still intact, and the money flow is still incredibly bearish. So when we see something like that, AA, our sense is this is an intermediate consolidation and that the bullish trend at least has a chance to resume.
Yeah.
And you notice in the last few weeks here, the 20-day look-back period, that's exactly what we're seeing. It's like the sky, the plane in a nosedive is kind of pulling out of it and regaining some altitude. And so these are the kind of things we put on our watch list and say, okay, looks like Italy might recover from a consolidation.
I've heard anecdotally that you can't do anything in Italy without running into an American tourist this summer.
Yeah, that's right. Now, so I bring this up because, and I was in Greece just in June, and I can tell you that both of those countries were just packed with people, tourists, and it was to the early part of the tourist season. But I bring that up because IWM, which has been gaining relative strength and has a, it's basically out of, roughly, it's probably just shy of 24, maybe about 18, 19 global ETFs. It's been moving gradually up in strength, or it's been persistently top ranked, and the trends are good. But the deal is we're just not seeing that breakout altitude on IWM. Yeah.
And the money flow is not supporting, as you've mentioned, the money flow is not supporting a sustained move higher.
Yeah, and that's what that's what I meant to say, is that we're not seeing that money flow supporting the breakout.
Yeah.
So put a pin in that. Let's talk about that. But I think there is an elephant in the room here. That while tech is a QQQ, I'm looking at now near the bottom, is very strong. The bearish calls for a calamitous market crash have just gotten stronger this weekend because finally the NASDAQ sold off a few percent. But QQQ is showing some significant money flow to the downside. And it did crash in rank, but the problem is it crashed in rank inside a 30-day look-back period.
Yeah.
Still pretty persistent in the 120 to 60, which means that, yes, we pulled back. Markets do that. And the tech was it was the only thing driving the markets higher, basically, right? For weeks, if not months.
Mm-hmm.
This 10-month rally, we've been pounding the table on how narrow it's been.
And it's also still above the moving averages,
Right.
So nothing's to say that it can't violate those, but right now it hasn't.
Yep. Now we'd rather see a pullback like Italy that's accompanied by money flow. And the last NASDAQ consolidation, the QQQ, in fact, featured that, where we never really lost. Money flow might have dipped to between 0.1 and 0.2, meaning only bullish instead of very bullish. But we never got a negative distribution level of money flow like we're getting now.
Yeah.
And then the other thing I wanted to point out was Taiwan. Taiwan is very tech heavy, semiconductor heavy, in fact.
I mean, basically is semis, right?
Yeah, there's one company that is basically the bottleneck for the global supply chain. SMC, is it SMNCI? SMCI?
Oh,
I have it in the new edition of Cheat Sheets.
Okay.
But about 10% of the market cap weight is that one company.
Yeah, I think SMCI, I believe.
SMCI, that's it. That's the one I didn't know I was holding. And it was good news. It was a bad trade, but a good outcome where through no contribution of any genius that I brought to the table, it went up a lot. But the EWT, that is a significant level of distribution at 0.28.
Yeah.
All right, let's keep going because we want to hold that IWM theme. And if you're a subscriber or you subscribe to Cheat Sheets, we go into the grading system. And we just have to remember the grading system is a double-edged sword. You can have a B rating, but be portending weakness to come.
Hey, can I mention one thing about SMCI and Taiwan that may be playing a factor here? Is Goldman recently issued a report that you can Google and go read for yourself that said that the AI trade has gotten way ahead of itself.
Yeah. And this reminds me, we're old enough to have traded through, or at least remember the .com era.
Sure.
I certainly traded through it. And that's back when I was an idiot and put everything into it was called the Janus Global Technology Fund that 2 years later became the Janus Global Death Fund, we used to call it.
Yeah.
And I've just seen this movie before where just because a new technology is showing incredible promise as it first emerges, investors always buy into the hype, get ahead of their skis. The price earnings multiples get ridiculous. I guess the difference is these companies have been attracting investor capital, but the problem is the revenue is still not there.
Right.
I mean, we're selling semiconductors, but we're not necessarily seeing groundbreaking application yet from AI. But it doesn't mean that AI is not going to be a significant revolutionary player. It's just, but pets.com sold at 100-to-1 PE multiples back in 2000. And, and they're not around anymore. We're going to go through that initial speculative washing out phase. It's just inevitable.
Just because something needs to be repriced doesn't mean that it doesn't have a future.
Right. Yeah. So we're going to, so I do agree with the bearish YouTubers talking about the tech bubble. We're going to get a crash and this could be the beginning of it. I just argue that investors aren't fully convinced. There'll be a tug of war for a while. And then ultimately earnings season will probably determine this. And maybe the news today has a more profound effect on markets than I think it does. We'll just have to wait and see.
Yeah.
Okay. And then, so here's now we get rid of the global ETFs. And I just wanted to first point out, well, yes, we're going to talk about the IWM. And again, on a relative basis, it's doing better than most of the other indexes. And as is microcaps, IWC. And microcaps actually is rotating into favor with a B rating, which means the average rank has to be top 50% in the sweet spot. Now, to get an A, you have to be in the top 30% in the more recent 10 to 50 day look back period, and you have to have a FOMO level of money flow of a 0.2. So we're not quite there yet. We meet 2 of the 3 criteria. So microcaps are bullish. There's no question about it. IWM, I'm bullish-ish. I'd call it neutral plus at best. And then, but I wanted you to look at what I'll call the fear trades. And maybe give me a VIX update if you know, but look at gold, TLT longer, the longer end of the treasury curve. That's typically where investors pile in a flight to safety. Yeah, we got a little relative strength rank improvement. We do have some intermediate positive bullish trends going on, but I wouldn't call that a panic move into TLT.
No.
Yeah.
No.
The dollar's losing value in anticipation of rate cuts and potential, if there is a recession, funny money printing that would follow. And and what's your sense? What's the VIX? How's the VIX, which is the fear index in the market? How's it been acting lately?
It closed the week at 16.
That's a pretty big jump.
Yeah, that's the highest that it's been since early May.
And what does the VIX represent, basically?
It basically represents put buying in the S&P.
And what is put buying?
Bearish positioning or hedging.
Yeah.
Basically, investors saying that they're concerned of a pullback in S&P price.
Yeah, or a speculator thinking the market's way over its skis, and I'm going to make money by betting against the market, and you make money as the market goes down.
That's right.
Yeah. And so that's the large cap index. The VIX is tethered to that. There's other sorts of VIXs, like there's a VIX for the NASDAQ, right?
Yeah, there's a VIX for almost everything.
For everything, yeah. And I would imagine the technology VIX, you don't have to look it up. I would imagine that's even higher.
Yeah, I didn't look at it last week, so yeah.
And here you can see NASDAQ is definitely now in 11th place, but that's only in the last few weeks. And so the money flow is negative. We have top 50% rank in the in the sweet spot, but because of that negative money flow, it loses its B rating, and it slipped from A to B to now no grade at all. No grade is bad, or it's a potential no grade can be attractive. Like, for example, if IWM's money flow improves, you see the relative strengths are already improving. All it will take is a move up to, we nearly got it a week ago. At the very beginning of the rotation, we were at 0.09. So we just barely made the A rating criteria or the B rating criteria, but then it pulled back this week. Okay. All right. So now we're going to do a more of a deep dive. And this is where I think your background in your studies to become a certified chartered market technician pay off here. So there's two ways to look at the IWM. There's the short-term time frame and the long-term time frame. Do you want to give us sort of like because there's a bit of a disconnect between the two, and we don't know which is right, but isn't it fair in general the longer-term time frame tends to be a little bit more reliable?
Yeah, it carries more weight.
It carries more weight.
I would say, yeah. And so we're looking at weeklies here.
Yeah.
Okay.
And so we had a big breakout,
and there was a lot of volume last week relative to weeks gone by. But that candle that formed for the week that just passed it's a shooting star candle, which is a quite bearish candle formation.
Yep. So that's where you see the big thin wick above, which represents, that would be the high point for the week, right? In price, the very top of that little narrow wick on the far right candle.
Yep. It's basically saying that sellers outnumbered buyers at those price levels.
Right. So what happened was early in the week, we had a big breakout, or the previous week, big breakout on some decent above average volume. I wouldn't call it huge volume. But then, market got euphoric and investors bid up the cost of the IWM, and then sellers came in and essentially brought it down almost to the point where it started for the week.
Yeah.
And so when you've seen that in the past, and I'm going to move to a different chart here. Just give me a second to try to figure this out. Okay. This is probably a better view of that candle.
Yeah,
I should have done that first. Okay. And this, by the way, is just a simple 21 period moving average. And this is, my stop loss. I actually took the breakout trade, but with a very tight stop loss.
And I was actually going to point out those moving averages. Look at how much distance exists between current price and those two moving averages. I mean, there's a lot of room there.
Yep. And the lower moving average is actually what we call a Keltner channel. So it represents 2 times the average true range of the security over the last 21 days. And you can see what's happened is that distance has expanded as volatility has picked up. So what happens is I use volatility-based stops just because when market volatility, the difference between highs and lows gets more pronounced, you can get taken out of a trade by having an institution run your stop, and then and then it recovers and you've sold your stock to them, and it happens all the time.
Right.
So we call that shaking out weak hands. So
getting picked off.
I position sized very conservatively because I knew that there was a chance that something like this could happen, and then this would cause some follow through. And AA, if you give me a second, let me go into our platform, and I'm going to change the screen here for a second.
Okay.
And let's see if I can find the, if I can do this real quick, where I find the work you did on the charts, which show kind of in the past what happens when we kind of call this brown capping or turtle heading, where we poke out and then come right back in, right? It's like a fake breakout.
And it's nothing specific, the idea is, applicable to everything, really. False breakouts tend to produce strong moves in the opposite direction.
So we've seen over the past decade or so some major turtle heads that have then resulted in punishing reversals.
Yeah. I will point out the one thing I noticed when I was putting this together. Yeah, you can go ahead and close that. Is that each of the yellow circles you see has been accompanied, several weeks before and several weeks after, by a declining RSI, and it also produces that divergence, where the peak in each one of those circles is on a negative RSI divergence. I'm not seeing that right now, which is
no, if anything, it looks like the RSI is getting healthier.
Exactly. So the RSI is making me scratch my head a little bit here.
Well, it could just mean that we're not getting the repeat, and the Russell may end up breaking out. I think this week is going to be a big tell.
I think so too. Yeah.
But I think, just to kind of go over the bear case, because there's going to be a lot of pundits they're screaming for the most colossal, epic market crash and housing bubble burst and financial crisis. And, I'm seeing the banks get better in my data, but the rhetoric for just gloom and doom has never been higher.
Which, by the way, tells me it's nothing to be concerned about.
Right.
Just the fact that the volume of the gloom and doom tells me that there's nothing really to be too overly concerned about.
That's right. So now, but the Russell is a good indicator of economic sensitivity. So, there is going to be a battle between the bulls and the bears in terms of, does the Fed rate cutting a quarter point at a time over the next 2 years, which is probably what we're talking about.
Yeah.
Unless the economic data gets slow, and then they'll panic and start cutting it in much larger volumes over much more of a time. But the one thing I would say about heading into rate cuts, that's generally not been bullish for markets. It's usually when the Fed has done rate cutting and potentially starting quantitative easing that we get the rally.
And not only that, but particularly the IWM, because the IWM depends on
easy money.
Well, not only that, but economic growth within the U.S. since they're U.S. small caps, right? And when does the Fed cut? Not when there's economic growth and expansion, right? So IWM following a Fed rate cut makes the least sense to me.
Right, because the Fed is cutting rates because unemployment data is getting worse.
Mm-hmm. And growth is slowing or contracting.
Housing growth is contracting, and they've kind of wanted that, but they don't want to crash the housing market. So if they start raising or lowering interest rates in 50 basis point tranches, then the Fed is worried that they're over their skis.
Yeah.
Their rate cuts their rate hikes went too far, and they lasted too long.
Since you mentioned the Fed, I know we didn't talk about this beforehand. I want to say, I think the most important thing the Fed has to do is communicate that whatever their cutting cycle is going to be, it's going to be slow and calculated and data dependent, and don't expect 25 basis points every time we meet, because that's when the market is going to, blow its top again and hit all-time high after all-time high, which is not what they want, I don't think.
Well, I don't think Jerome laid out a schedule. He basically switched to, oops, sorry about this. This is the free version of your chart, so I'm getting all the ads.
Oh, sorry.
That's all right. I don't subscribe. I used to. I love the TradingView, though. It's a good platform. Yeah. The one thing I'd say about that is Jerome did, over the last 2 weeks through various speeches, he's changed his tune and told the market to get ready for rate cuts. I mean, not in so many words.
Right. It seems, the market's priced it in for September at this point.
And I would say the inflation data, which has cooled substantially, the jobs report is showing most certainly signs of, it's kind of hard to, I think they've been doing a good job of hiding the salami, but the job market is much weaker than the data releases showing the very first pass at housing data. It's been revised downward for months now.
Yeah.
Meaning the job growth is far less substantial than the top line data would have made it out to be over the
Yeah,
last several months.
yeah, I've been working pretty hard on writing a piece for that, and there's no conspiracy there,
Right.
and I know you don't think that, but a lot of people think that the BLS is in some conspiracy to make it look lower.
Yep.
It's the bullwhip from the COVID effect, and also just the way they gather data is
It's a phone-based.
it's pretty antiquated.
Horrible.
Plus, now they contend with millions of immigration, right?
Yeah.
Millions of people here. So, anyways,
Yeah.
yeah, it's probably weaker than it's been reported, no doubt.
Yep. So the government data is just getting increasingly unreliable because their reporting methodology hasn't changed, while the way consumers and employers go about business now is completely different. You just don't reach people on the phone anymore.
No.
Yeah. So I think everybody's recognizing that the revisions are, there's a small pocket that thinks it's conspiracy. I'm just of the mind that bureaucracies are entrenched. They're slow to move, slow to react to the new way of doing business here. So
absolutely. And also we both recognize those things can all be true. And also this is in fact the currency that policies are made off of. So let's interpret it.
But I think we do need to respect this history, turtlehead and down, even if it's not a market crash into a bear market, turtlehead and down, turtlehead and collapse.
Yeah.
Turtlehead, consolidation, down, turtlehead, down. It is a pattern that has repeated with only the RSI now doing higher highs. And the RSI is basically a different version of relative strength. It's comparing an indicator's performance to its own performance in the past. And it's like a baseball team. You're measuring how many games won out of, 14?
Yes.
So,
yes.
Yeah. It's trading, up day at closing at the highs or down day. And so you put a win on the board if it's an up day, you put a loss on the board in the down day, and the RSI, when it's at 70, it means it's like batting 700 or having a 700 winning percentage. And that's only sustainable for so long, unless you're, the team with the incredible league record. Most people can go on, hot streaks. Most teams go on hot streaks 7 out of 10, but more often they retrace to the mean. And that's what's happened with the Russell each time it's broken out. The RSI has gotten high and then it's reversed ahead of price. And this time, we seem to have a relative strength breakout going along with the breakout.
Yeah, it's definitely different, at least thus far.
So I guess we're inconclusive, but I'm not expecting the IWM to just race to new highs out of FOMO unless this news today significantly convinced enough traders who believe in the business-friendly thesis of a Republican-controlled government. That would be the reason, perhaps, for a new panic up starting tomorrow. I'm not sure it's sustainable because I think ultimately earnings and economic data are going to matter more than U.S. politics.
Yeah, agreed.
Okay, so we're gonna close things out here and take us to the final mile. Just a few more charts.
Okay.
If you give me 1 second to remove this, and I will add back to the other tab, which basically is the graphics from today's cheat sheets. That'll be sending out shortly after I record this video, and then I'll do the podcast out tomorrow morning. So in fact, if you're receiving this on Monday morning, you can refer to the data release that's in your inbox on Sunday. Okay, so we're going to stop sharing that screen, and I'm going to share a new one. And I wish there was a better way to do this. Okay, so we've covered the indexes, we've covered the IWM cases, and I just wanted to quickly look now at sectors. I kept the major indices in there just so we could see.
Okay.
I always like to compare things. But here's your case for financials. So financials, 8th place on average out of 11 sector ETFs. Of course, it's 8th place. We're including the index ETFs in the ranking too. So this is a little bit skewed because of those index ETFs, all of which are lowered right now than a lot of the sectors in the U.S. economy. This is a very narrow bearish turn, if you think about it, in terms of the where have we really collapsed? It's in tech and the Qs. Yeah. And there's IWM growing in strength, number one, but tepid money flows we've talked about. Real estate. So that has a transition from 16th to 3rd in the sweet spot, and we've maintained that. And we have a 0.21 shaken money flow. The only reason that this one doesn't have an A grade right now is because the average relative strength rank is outside of the top 50%, meaning it's not ranked of these 16 or so ETFs. It's right at the 50-ish% market. If that one more week of relative strength performance, and that will get it's 10th on average here. So that's outside the bottom 50%. So just a little jump up in relative strength, it turns XLRE into an A grade. Can you, let me do the bull case, but then I'm very interested in the bear case we talked about during prep today.
Okay.
So the bull case is that, yes, while the commercial real estate market looks terrible, the fact is that the residential real estate market looks good, driven by rate cuts that will actually improve home values because it will widen the base of people that can afford mortgage payments. And the other thing is that with a lot of private equity and hedge funds buying up the residential property in cities like AA. I remember you gave me a tour of Denver last year, where you lived up until recently, and you claimed, you told me that there was you could not buy a condo generally as an independent condo buyer, right? You had to rent because all of the big commercial, the shadow banking system owned the real estate in downtown Denver.
Yeah, there's very few condominium buildings in Denver, all apartment buildings. So yeah, it's true, and they're owned by hedge funds, investment firms, etc.
So we call that the retail rental market, and then there's also the duplex and multifamily market, where people can't afford homes, have been priced out of the real estate market, or hey, you have to have a place to live. Mm-hmm. And then that's another place where private equity and the other aspects of the shadow banking system have cut the deals with the devil, I guess. And so that's the bullish thesis for why we're seeing this rotation, all driven by rate cuts, the potential for expanded value, the rental market, and the potential increase in housing affordability, leading to higher home prices in markets that haven't been, or in markets that have already corrected. Go ahead.
So I'll take the other side of that and say that if you look at the top three in the rank here, financials, IWM, and real estate, clearly, the rate cut narrative is driving things. Although TLT, which is,
they're not really in the top three when you go to the average relative strength 3 to 6 month. It's a little bit deceiving because at least only the last 10 days.
10, 20 days, yeah. Meanwhile, TLT, the actual bond itself, is underperforming, which I find curious. But as far as real estate goes, I think, and I just wrote a piece about this on my Substack, Macro to Mortgage, that we very well be positioned to see something called a bull steepener, which is where the Fed starts cutting the only rate it can cut, which is the Fed funds rate, the bank's overnight rate, and the short end of the curve follows suit.
Yeah. But there's no interest rates on the the 6 week Treasury or the 3 month CD start going down.
Yeah, and maybe even the 2 year. Who knows?
Yeah.
Who knows how far it goes up the curve? But there's nothing that guarantees. There's nothing that says that the 7 and the 10 and the 30 have to follow the Fed.
Right.
Because they're much more sensitive to economic developments, right? Like growth, how much Treasury, how much debt has to be issued, which
real economic performance.
Right. And so a bull steepener would be where the short end falls on Fed cuts, and yet the long end doesn't move, or worse, it could even go higher.
And what we mean by the long end going higher is not bond prices, but you're talking about interest rates.
Interest rates, right. Yeah. So interest rates on the short end of the curve could fall as a result of a Fed cut, and yet interest rates on the long end of the curve, 10-year Treasuries, 30-year Treasuries, mortgage rates, those things could all stay firmly planted where they're at, or go higher depending on how it plays out. And that could very easily, that scenario could very easily play out, I think. And I think
would explain the lack of a flight to safety, even in the face of some pretty gloomy economic news, especially in the employment and housing sector.
Yeah, and I'll just add one other thing onto that. If you look at the current 10-year futures contract, there's a lot of open interest on the put side. So investors, playing for a downside move, and not only on the put side, but well outside of one standard deviation.
And what are the puts on specifically?
They're basically a put on the 10-year Treasury is
the bond going down.
It's a bond going down, which is rates going up, because of course they're inverse.
Which is counterintuitive, because you would think, well, that's right. You would think that the rates would follow like they have every time in the past, right?
Right. So if you were bullish on lower yield on the 10-year, you'd be buying calls,
Right.
not playing on the puts. Right.
Right. And again, yield, not the underlying bond itself, which is because TLT would be a 20-year long duration treasury and a call would be a bet against interest rates.
Correct.
Yeah.
And I'll put a bow on that by saying that
Mm-hmm.
put activity is outside one standard deviation, which means that not only are investors for one reason or another expecting or playing for a down move, they're playing for a big down move.
So, the idea of a 60-40 portfolio, if stock prices don't melt up because the declining dollar and rotation into small caps and bullishness that results from interest rate cutting, if that doesn't happen, then there's a chance that the 60-40 stock bond scenario into a recession is going to be the worst of all possible worlds for investors.
Everything will move in the same direction.
That is a bearish thesis.
Yeah.
And so rate cuts are explained by the lack of a flight to safety. And the other thing I'm noticing is, despite the decline in the dollar, which we showed in an earlier index chart, and we're not showing it here, but the gold price just not coming along for a ride. But that bull steepener would explain why financials are suddenly in vogue, right? Because if there's going to be the ability to get overnight funds from the Fed at low rates, lend them out to 10-year investor time horizon investors and greater, then banks do really well in that scenario.
Because your cost is going down, and yet what you're lending out at is not.
Yep.
Yeah.
And so banks would make profits on mortgages and other sorts of loans that are long duration.
Yeah. Yeah.
And so that might be the explainer for real estate and financials to kind of buck the overall, what I'll call not bearish trend, other than in tech. In tech, we got a little bearishness going on because we're extremely overbought. The rest of it is just meh, with the exception of healthcare, where we don't have much in the way of sector rotation, but we've got some trends, and we do have a slightly bullish money flow score.
Yeah.
And finally, and by the way, we summarize kind of all of that. Although I don't really get into the bull steepener. So for those of you who are listening to this podcast, you're getting some, maybe more representative treatment from bigger voices. I spend more time on the banks profiting from interest rates, but more on the bullish case for the housing market than AA is. All right, so subsector ETFs, we start to break it down now. So remember, we're going to kind of keep the lens on financials, and you'll see that when we look at the kind of the major components of the financial sector, KRE is regional banks rotating, and you'll notice top 50% here, top 30% here. So the relative strength rank is intensifying. Trends in all three time frames. You have to have both the 1040 daily and the 1040 weekly bullish in order to qualify for an A, and you need money flow above 0.2. So that's a high bar.
Yep.
And so regional banks, where there's all sorts of gloom and doom about how regional banks are just on the verge of collapsing, the data suggests the big money investors think differently. Right. Second are big money center banks at KBE, first on a 3 to 6 month average, and then here we're no worse than fourth over the last 50 days. 0.19, just barely outside of an A grade. It's 0.01 away from getting a grade A. And then finally, capital markets, KCE. So this is investment banks and broker dealers and people who traffic in capital markets. The shadow banking system, private equity, to the extent that they influence publicly traded markets. Look at that, 0.44.
Wow. Yeah.
Grade A, multiple uptrends, little softening in the relative strength, but not enough to bump its averages out of the top 1/3, the top 50% in the two different timeframes that we look at. Meanwhile, there's the SPY, which had been driven by all large caps all the time. You can see that there's not much underperforming it other than tech. And once again, speaks to the thinness of the rally. I would say the opposite is maybe the thinness of the sell-off, Plenty of green here, just a little bit of red. Retail, yep, retail stocks don't look great. The consumer is stressed. Aerospace, a lot of airlines have missed some earnings, or they've warned lately. And software and services, part of tech. That's where the red is. But otherwise, we're green or at least yellow. So either taking a pause or taking its turn.
Yeah, nothing overly concerning to me, at least.
Yep. So we kind of give you the summary that does include some of AA's analysis, inadvertently give you the implications. And then I would say tomorrow for our premium subscribers, we will take a look at leveraged ETFs, the other half of the equation. And I'll do we'll do a relative strength rank and trend report to see where money might be moving short in a substantial way. And remember, it's a bullish metrics about a bearish thesis. And then we'll also be looking at some top-rated fundamental picks with good tailwind scores, our proprietary ranking system of the current snapshot of stocks in KRE, KBE, and KCE. AA is a licensed mortgage broker in Colorado. He puts out a great newsletter as part of his, let me make sure I get this right. It's localadvantagemortgage.com, right? And your Substack is called?
Macro to Mortgage.
And AA's specialty as a mortgage broker licensed to the state of Colorado is that he watches interest rates and treasuries like a hawk to help investors eke out extra tenths of a point in mortgage interest, right? So if you're buying a house, sometimes a few basis points can really make the difference in your payments.
Absolutely. $100 a month, $200 a month on a couple of basis points, money in the bank.
So if you're thinking about buying or you're getting ready to think about looking because interest rates may be coming down over the next 6 months, get in touch with AA and he'll start watching the mortgage markets for you. And I know you go out of your way to service individuals. You'll make sure to give them a heads up if the buying conditions improve. Right now, they're pretty awful.
Yeah, affordability sucks.
And I am Mike O'Connor, who tends to be very easily manipulated by bearish rhetoric online, and I have to sometimes check myself with my own data, which is why I built cheat sheets data. I use it to make intermediate trades, and yes, most of that happens within a year round trip. So it's not the stuff I'm putting aside for retirement or for college funds or other sorts of long-term expenses. This is what I use to do things like go to an EDM festival in Las Vegas this past weekend, or to another concert in Albania the month before, or a luxury cruise next January. Believe me, I am not made of money. But what I do is follow the data and place some risk managed bets and make money to do fun discretionary things. And that's what the cheat sheet data service is all about. It's, again, not a recommendation to buy or sell anything, but a starting point where we can eliminate 20 and 75% of what you'd otherwise consider for this type of investing and get it down to the few things that you're willing to place an options bet on, or to sell a put, or to outright buy stock.
Just dig deeper.
Thank you, AA. I know you're about to get married, so we may not see you for a couple of weeks, but we'll get back at this. We'll get back at this in mid-August once we have a chance to let a few of these factors play out. Meanwhile, see you every day on cheatsheets.substack.com.
Thanks, Mike.